Hello and welcome to a brand new season of NSE FinWiz powered by CNBC TV-18. Last season we travelled across the country and stopped over at 20 companies and met their young professionals who were given some sound financial advice by our experts. And this season we are back bigger and better than before. On this opening episode of Season 2, we're at the Pune campus of one of India's leading consulting and business re-engineering solution providers, Tech Mahindra.
Founded in 1986, Tech Mahindra is an Indian multinational provider of information technology, networking technology solutions and business support services to the telecommunications industry. The organization has operations in more than 30 countries with 17 sales offices and 13 delivery centers. This prestigious organization has over 9,200 professionals across 51 countries and provides services to 632 global customers. Tech Mahindra's vision is to consistently achieve top quartile growth by contributing to their customers' success. Tech Mahindra also believes in making it possible for the employees to realize their potential and work towards generating value-driven services for the stakeholders. Tech Mahindra is a part of the Mahindra Group that employs more than 180,000 people in over 100 countries. Focusing on our theme for the series, NSE FinWiz visited the spectacular campus of Tech Mahindra in Pune to gauge the thoughts and notions of the young employees on investments and financial planning.
I used to invest in FDs, but later on I came to know that the returns are more in share market and the mutual funds. So I started investing slowly when I started earning. So I started a little bit amount every month, keeping it aside and investing in the share market and the mutual funds.
I always wanted to know about what mutual funds, how mutual fund works, because I have seen people investing in mutual fund on a large number of amount. They have whatever money they are investing in mutual. So I want to know what exactly how mutual funds works.
Investment is like the saving potential which can be multiplied, because whatever the amount of saving capacity you have, if you put it in the right investments, obviously it will have a more possibility to grow. Because when you have suppose a 1 lakh of amount, you should not go get invested into one particular segment. I think it should be diversified investments. When there is a possibility of investing in something called land, you can invest there. When you don't have that much of amount, you should look at other options. Investing in gold for some amount and invest in stocks for some amount, and some for fixed deposits which will have secured and safe amounts of returns.
I would have to ask them that since I'm a fresher, I've joined and started earning right now, so I would like to know that what would be the best plans for me to invest so that I could get a maximum returns and could reap out the maximum benefits out of what I'm investing into.
I haven't invested, but I do have some idea about investments. Like we have mutual funds, we also have PPF, FDs. We have a recent recurring accounts. We can invest in that. So we also have options in stock exchange. We can invest in shares. Gold is one of the options because people invest in India. Most of the people invest in golds, and my parents invest in PPF and FD, which I'm familiar with. But I haven't invested in anything yet. So I think if I'm going to invest, I'll do in FD or PPF.
Well, I'm now joined by two very special experts. First up, we have Mr. Harshvardhan Roongta, who's a CFP at Roongta Securities. And we have Vijay Chabaria, who's a CFA charter holder with Prudent Investment Advisors. Thank you, gentlemen, for being here. Harsh, first question to you is, let's talk about starting investing. There's always a talk, people say that, it's good to start investing early. Is that true, and why?
Let me explain this with an example to you, a financial calculation, very simple calculation. If you were to invest 1,000 rupees for a period of 30 years in an equity asset class, okay, which generates say about an average return of 14% over the next 30 years, the amounts that you will accumulate after 30 years would be around 54 lakhs. Okay, and the same person says, I have just started, let me enjoy myself, let me get 5 years down the line, I will start making the investment. So 5 years later, this gentleman starts making the investment with the same 1,000 rupees, but he has say 25 years now because he is not invested for first 5 years. What is the corpus he is likely to accumulate after 25 years vis-a-vis another person who is invested for 30 years? The figure that he will accumulate after 25 years is going to be 26.5 lakhs. Against a person who started 5 years earlier and he's accumulated 54 lakhs. So just 5 years of delay has basically eroded your corpus by 50%. That's the power of compounding.
Vijay, okay, so let's look at this. He's spoken about this, everybody is worried now that I should have started earlier. We can't turn back time. What is it, how should we start investing immediately then? It's never too late, you would say?
Sure, it's never too late. I think the first things you need to do is look at protection. So you need to have a contingency reserve of about 3 to 6 months of the amount you earn lying invested in an ultra short-term fund, which earns you a little more than a saving bank account. The biggest income generating asset is yourself, right? You need to ensure your health. You need to ensure your life. You need to have adequate protection for your family. So these are your protection needs. If you haven't had the time to sit with a planner or an advisor, it's never too late to start. You need to basically have goals in life, which are basically your responsibilities and your aspirations. So it's as simple as saying that a person without goals, it's like you're setting sail into the high seas, but you don't know what your destination is. Basically, that's the way you need to do it.
So fundamentals, basically goal setting, asset allocation, and monitoring it. So I'll get back to that. But before that, if anybody has any specific questions, maybe we can get you guys in also on that. Harsh, let's talk a little bit about asset allocation, but by way of, everybody is confused by what are the main fundamentals, what are the main contents of how I can put my money in which vertical. There's equities, there's gold. So just talk a little bit about that.
We've all learned something from our parents. Don't put all your eggs in one basket. So that theory holds good even today. What is important is, if I have, say, 100 rupees to invest, how much should I put in equities, how much into debt, how much into probably precious metals, and if at all we could include real estate into our portfolios. So the bigger question is, we know we need to allocate our assets into different class of investments, but how much? Now there are thumb rules, okay? I'm not a fan of thumb rules. The thumb rules say that 100 minus your age should be in equities, okay? But if you look at it, if you have an access to a financial planner, or if you get a little more detail into your own finances, you will see that two different people have different requirements. Say two people who are 30 years of age. One person has only retirement as his goal. So he has time horizon, which is say probably 25 or 30 years from now. The other gentleman who is 30 years of age, the same department, earning the same kind of money, but he has a responsibility to get his sister married in 1 year. So he obviously cannot invest into equities. And if you're talking about 100 minus age, so 70% cannot go into equities. So the answer to this question is, you need to basically look at what specifics are, what are your own individual specifics.
On that note, it's time for a very short break. You're watching NSE FinWiz powered by CNBC TV-18. We'll be right back. Welcome back. You're watching NSE FinWiz powered by CNBC TV-18. Let's talk about equities. Now, there is a little bit of confusion very often with people is when they say equities and they say mutual funds. But it's actually, mutual funds are just a vehicle to invest in equities, but people are very confused about that. So if you could shed some light on mutual funds and what are some easy ways for these young professionals to invest in mutual funds?
Sure. So we often hear people say, I invested in a mutual fund. So like Sumit mentioned, mutual fund is just a vehicle where you basically invest through the mutual fund into either an equity fund or a debt fund or a gold fund, or what we call hybrid funds, which are a combination of equity and debt. So let's just take a little example of the different classes of funds that are available. So if we take equity funds, basically they're divided basically in terms of market capitalization of the underlying stocks in the portfolio. So you can have a large cap fund, you can have a mid cap fund, you can have a small cap fund. We can also have index funds, which basically is a passive way of investing, and they invest basically exactly as per the index. We have sector funds, like you guys in the IT sector, so you can have an IT sector fund, a banking fund. You also have international funds, so you can invest abroad via the equity route. On the debt side, we have ultra short-term funds, which basically is good to park your money in for a short period of time, which would earn you a little more than your savings bank. Then you have some income funds. You have something called FMP, which is a fixed maturity plan, after a fixed period that you're going to receive that money, there's less interest rate risk in that investment. And then you have bond funds, which are interest rate sensitive and invest largely in government securities.
Harsh, let's talk about real estate. That's a favorite topic for people nowadays. Is real estate a good investment option in the current state? And there's something called REITs that we've been hearing about. What is that? If you could just talk about that.
See, well, Sumit, real estate is an asset class which has given you good returns. Now, how good are the returns? That is, it's a competitive.
Yeah.
Now, what happens is, we're not saying that real estate is an investment that needs to be made or it need not be made. Now, it is subject to an individual. Look at a scenario. If you were, we've heard of people saying that I had invested into real estate in about 30 years ago and today I've sold it for a couple of crores. Now, what is important for you to not get swayed away with the figures that have been thrown at you. Suppose somebody says I sold a property for 5 crores and I bought it way back 30 years ago at a few lakhs. What you need to do is that you need to take out the returns that has been generated. Sometimes we get too fascinated by big numbers. But when you come down to your returns, you will see that the returns are on an average about 17 to 18%, which has been the case with even equity investments. So what is important is that you calculate the returns that an asset class has given. Secondly, the underlying theory behind real estate is that it's generally people hold it for long term, which does not happen in case of equities. As much as we may say that you should stay invested for long term, you should stay invested for 30 years, that in reality does not happen. We tend to, because it's a liquid asset. So real estate, yes, you can form a part of it. I mean, you can own it. If it's your first house, of course, you need to have it. I would not call that investment at all.
Vijay, I want to talk to you about another asset class that is a favorite for Indians, which is gold. So everybody would have gold jewelry, your mothers, your sisters, if you've seen it in the house. But now trends are changing. People are actually investing in e-gold, or electronically you can invest in gold. Is that a good option?
Basically, there are a couple of ways that you can invest in gold, apart from buying physical gold, of course. There is a gold ETF, or an exchange traded fund, which if you have a demat account, basically you can buy it like a share, which is nearly equivalent to a gram of gold on the stock exchange. So basically that ETF will track the price of gold. If you have a demat account, that is an efficient way to purchase gold. The other way you could do it is from a mutual fund. So if you don't have a demat account and you can go to a mutual fund, you can even choose to invest a smaller amount. You can do an SIP. So in that way you can remain disciplined.
Harsh, let's talk to you about financial advisors. Why should they get a financial advisor? They can read up, they're watching CNBC TV-18, they'll go online, they'll get the information. I mean, it'll be like, why do I need an extra cost of getting a financial advisor when I can do it on my own? What's your take?
You have to, possibly consult somebody who matches with your wavelength. Okay, there are a whole set of people with different mindsets. So you need to basically meet people, not just one, meet 2 or 3, and understand where you connect with the financial advisor. And then you need to construct your portfolio. Now, if you look at the cost part, well, if you're going to pay a particular fee, and if you look at the larger picture, and if you're looking at, say, 1,000 rupees is what we're talking about, the example that we used. If you're going to look at 54 lakhs as a corpus, against which you have paid probably 2 or 5,000 rupees as fee, I don't think it is something which is going to be bothering you. Right. But if you look at it from saying that I am investing 1,000 rupees against which I am paying 5,000 rupees as a fee, it's definitely going to hurt you. So how do you look and approach your investments? Are you looking at 1,000 rupees or are you looking at building a corpus of 54 lakhs?
Vijay, we've reached now a generation where we're living more with plastic money rather than paper money. So we use a credit card, debit cards, and you're regularly getting a call from some bank or the other saying this is the credit card, take it, low charges, etc. And we get very happy when we come to know, oh, my limit is 2 lakhs. But that doesn't mean that I can go out and spend 2 lakhs. Tell us a little bit about that.
Sure. It's important to be disciplined. It's important to understand that that is just for your emergency, extreme emergency use. If you start revolving on credit cards, it's like a vicious cycle. The interest payments on credit cards are nearly 3% a month, so which is 36% a year. So one needs to realize that you're investing to make a return of 12-14%, and on the other side you're revolving credit card payments of 36%. So just think about it, use it a little judiciously, and you should be alright.
Well, you're watching NSE FinWiz powered by CNBC TV-18. This is season 2, but we'll take a short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE FinWiz powered by CNBC TV-18 season 2. It's now time to go over to the audience as they put forth their questions to our experts.
I would like to ask you about the critical illness and personal accident. So these two insurance you didn't cover yet. So what is the importance of this cover and why we need, and what is the impact if we will not cover, if we will not buy this thing?
Hypothetically, if you were to meet with an accident and you were completely disabled, your EMIs are going to continue, your day-to-day expenses are going to continue, and your life insurance is not going to pay you because you're still alive. Right? So what happens to financial planning in that aspect? There are dedicated insurance policies which focus only in this area. In case you're disabled because of an accident, then a particular amount, which is a portion of your sum insured or the complete sum insured, depending upon the disability, the level of disability, is paid out to you in your hand while you're alive, which you can use for your own self. So I would say, if life insurance is for the protection of your family members, a personal accident or a disability insurance is for your own financial security. Now, same way, you could be rendered disabled because of an illness. There could be a stroke, a paralysis attack, or a heart attack, okay, which renders you disabled. Now, what happens? You get hospitalized. The expenses with relation to hospitalization expenses are taken care by Mediclaim. But when you get out of the hospital, you're earning the productivity that you can put in is probably not going to be the same. It's going to reduce, or you may not be able to work at all. So what happens? There is a loss of income. So again, there are standalone health insurance policies which address to this particular need. So Mediclaim, the cost of hospitalization is taken care by another policy which is called Mediclaim. You have standalone health insurance policies which are probably called critical illness. They're called by different names. But the objective is, if in case you're diagnosed of a particular ailment which is listed in the policy, you will get a payout, irrespective of whether you got yourself treated or not got yourself treated. So that lump sum can be used to match the loss of income that you have because of this particular illness.
In these days, I've heard the sentence coming up, don't invest the conventional way. And seeing the pattern, the gold ETF is given since the previous year, like how much percentage should be the investment in gold, probably the equities and retail markets?
The allocation to gold should be 5 to 10% of your portfolio as it stands you in good stead during turbulent market conditions. But just generally on the whole, regarding your investments, you need to be following a systematic investment plan. You need to do it regularly. You need to be disciplined. Even people who invest into equities, they often worry about short-term volatility and short-term price movements, things like that. Over a long period of time, if you see equities, you take the last 5 or 10 year rolling returns, even though we saw like a bad patch a few years back, you still look at some of the returns these funds have given. It's always been double-digit plus returns. So one really shouldn't worry about just do it in a disciplined fashion.
Well, that's all the time that we have today. Thank you so much, Harsh. Thank you so much, Vijay. And thank you so much for having us here. Thank you.
Thank you very much.
It's a very good show, especially for a person who just started investing. The experts told a lot of tips to them, and so I think it's a must-watch show. And also they told, like, if you started investing early, it will be beneficial for oneself. So definitely I would like to keep that track. I would started investing now on the tips given by them.
I have been investing in equities, but with this session I got more knowledge, and accordingly I will go forward and invest it as per the experts which I had discussion.
So I got to know how to invest, actually how to safeguard my risk, safeguard my interest, and to limit my risk by taking advices from the advisors.
Well, that's all on this episode of NSE FinWiz powered by CNBC TV-18, but we'll be back next time from the campus of another company. Until then, if you have any questions for our financial experts, please feel free to email them at fwq@network18online.com. Until then, from the entire team, many thanks for watching.